Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us today. Coming up on the show, Patrick Horan, principal at Agilith Capital, will be joining us for the hour. And in 30 minutes, we'll be joined by Curtis McCord, policy analyst at the Canadian Anti-Monopoly Project. He's going to break down a new report that warns of cloud concentration risks as Canada invests billions in AI. And of course, we want to hear from you this morning on First Call. Reach out with your questions on North American equities, and we'll have Patrick answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, if you'd like to go that route, firstcall@bellmedia.ca. Now, here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada-U.S. Trade Minister Dominic LeBlanc is traveling to Washington today to meet with his American counterpart. It comes as Canada's official negotiations over its trade agreement with the U.S. have yet to begin. The Canada-U.S.-Mexico trade agreement is subject to a mandatory review. U.S. Representative Jamieson Greer suggests the Trump administration is unlikely to rubber stamp a renewal. Shares in Hewlett-Packard are on the rise today, up more than 25% in pre-market trading following its forecast for annual sales that topped estimates. HPE cites growth in AI driven by demand for its servers and networking. The company is one of the largest makers of computing equipment, benefiting from the demand for hardware to train and use AI. Shares of Dollar General are rising in pre-market trading as it beat analysts' expectations on profit and sales in its first quarter report. The company says it was able to raise prices to offset severe winter weather and higher fuel costs. The American discount store chain also raised its profit and sales forecast for the coming year. It plans to open about 450 stores in the U.S., 10 more in Mexico. And now our top line story. Anthropic has filed confidentially for an IPO that could come as soon as this fall. The company hasn't set pricing or share size yet, released any of those details. The filing, though, comes just days after a major funding round that pushed its valuation close to $1 trillion and puts it ahead of rival OpenAI in the race to the public markets. For more, let's bring in our guest for the hour, Patrick Horan, principal at Agilith Capital. Patrick, thanks as always for joining us on this. If you're into IPOs, it's a great time to be alive, isn't it?
Isn't it? Big IPOs.
Big, yeah. They're not these aren't tiny ones, are they?
What was it? Was Apple was the first $1 trillion company about 4 or 5 years ago, and now
there's 7 million, isn't there?
A company's going public at $1 trillion.
Yeah.
SpaceX as well,
like close to 2.
Yeah. So it is pretty phenomenal. It's astounding to think that no one knew the word Anthropic 3 years ago, and here we are. So that kind of pace makes me cautious. I'm sure makes a lot of viewers cautious as well, just on how fast things have grown and the speculation of how to backfill that with growth. We are a user of Anthropic. Mm-hmm. We quite like it. We see the appeal of it. It is pretty amazing stuff. But there are a lot of competitors in this market, and Google through Gemini and OpenAI and Microsoft and SpaceX there, and you've got 5 or 6 Chinese companies who, Canada's going to be developing their own. There is going to be a lot of supply here.
Is there room for all of that, or is this one of those markets where there can only be X winners?
This is a CapEx expansion race, and these guys are going to they only know one thing, and that is size and scale. And so you just see every day, Google's in the headlines today about raising money to spend yet more money. Mm-hmm. So they all know it is about spending to get to that kind of scale. And there might be like 2 or 3 players that basically survive this or scale up to critical mass. This is using the old paradigm for technology
Does that hold still though? The old paradigm?
It's a good question. I don't know. That really is like in AI. Do you really need to scale? And we just don't know that. Like the whole idea of the network effect. That as your network becomes bigger, it becomes double your network. It becomes increasingly more powerful, right?
Yeah.
Facebook is a classic example of that. Do you really get those kind of benefits from a scale model on AI? I don't know. It's really like there's so many new things coming at us. Try to understand and see if the paradigm fits. These are questions that I wish I could come back from 2 years ago or 2 years
forward. With a crystal ball and away we go, right?
Yeah.
So it sounds like though you're staying away from these.
Yeah. We don't.
Same with
we
SpaceX
don't play. We like the technology is great. We're using it. We're seeing tons of benefit from it. So I do believe that just like the 90s where we had the PC, Windows 95, open, basically everyone got a home PC, and then from there we had email and dial-up servers and BODs, and then we got faster and faster, and when we got the one megabyte network, and that all of these things started to come to play, and it just kind of drove spending. It drove improvement. We think we're in a very similar era. The one thing that strikes me is that there is with every boom and bull market, there's always very heavy capex cycle, and those guys seem to be leadership in terms of driving the cycle. But I'll tell you, their stocks typically don't work out well when they go into hyper capex mode, and so I look at that and I go, I just don't need to play there. There's so many other opportunities here, and we can own some of the suppliers to these big data centers, or there's other ways to play this, to be on the right side of where scarcity demand is.
Well, and it feels like just anecdotally, but with IPOs, if you're not on the ground floor, do you really want to be in when they open to the public?
I think there's a gamification going on right now with the venture cap guys. They see it. I think we're going to talk about this, but you've got the passive funds involved now in a way that I've never seen. So passive funds usually had these gating things of when a company could enter the S&P 500 and NASDAQ 100 and the Dow, and it had to have very strict criteria. Those criteria is getting whittled down, and SpaceX is going to go right into the NASDAQ 100 almost from the get-go. Mm-hmm. And the S&P, those guys are pressured to say, well, these guys have it. We can't let the NASDAQ 100 outcompete us. We need to have it. So there's a game of momentum in passive investing. Yeah. And given that's the way everyone benchmarks, as a manager who plays that game, we don't play that game. Play an absolute game out on a relative game, which is, probably speaks to about 80% of the funds out there and pensions funds. They have to figure out whether they're long or they're short. Yep. Are they short the index, short this portion of the index, long the index? So everyone has to invest their time to understand. And it's tricky because you could have said that about Google when it first came out, and it just, all it had was a search bar, and you go, I don't get it. Where's the advertising, right? Yep. And so it is. I don't want to. It's just we don't have those visions to understand how growth really takes hold, and we know it's kind of fraught with all kinds of mistakes. So we don't play in that camp.
Okay, we're going to wrap it up on that note there, but lots more to talk about. But up next, we'll take a look at the markets before the bell. All right, let's see how things are shaping up on the markets. And for that, we'll start with the U.S. futures. And they're in the red right now. Could be ending that nice little winning streak the S&P has been on right now. You can see NASDAQ, they're all hovering around record territory. The NASDAQ above 30,000. It's down right now by 0.11. And the S&P 500 also off by 0.18. Trying to figure out what's unfolding in the Middle East. That's the biggest factor right now. Is there a deal? Is there not a deal? How much of an issue is Israel? Heading over to Asia. And the Nikkei back a little bit, off by 0.3%. It has been on fire over the last year, though. Overall, it is up, let's just say that. Hang Seng up by 2.5% right now. CSI 300 up by 1.5%. Maybe some optimism there on what's unfolding in the Middle East. Off to Europe now. And we got all green lights there. FTSE 100 up by 0.25%. CAC Caron by 0.72%. And the DAX is up by 0.84%. Some optimism there. TSX yesterday struggled to find itself. It was a little bit all over the place for most of the day. In the end, it was dragged down by materials and financials. Closed off by 0.1%. Third record high, third highest close, though. It's in pretty good territory right now, shall we say. Some of the winners and losers from yesterday. Celestica up by 10.3%. Parex was up by 10.25% on that news that it closed its deal to buy Frontera's property down in Colombia for $500 million. So that deal closing yesterday. And going the other way, Orla Mining off by almost 8%, and Equinox Gold off by about 8.2%. Taking a look at the metals, bouncing back. Gold still in that $4,600 range, up by 1.1%. Silver pushing up over 76.5, up by 1.72%. And copper, it's on a nice little roll right now. It's up by almost 1.4 at 664. Western Canadian Select yesterday dropped a little bit, down 71.43, off by 1.8%. What is WTI doing today with all the uncertainty with Iran? Let's have a look. It's off right now, 1.5% at 90.76. All right, there is a real disconnect in the market right now. Cautious sentiment on one hand, but stocks edging higher. We're back now with Patrick Horn of Agilent Capital, who says stronger than expected earnings with help from AI are a big part of the story. Mm-hmm. A lot of it doesn't make sense sometimes, does it? Right?
Yeah, no, there's really a confluence of factors here. So for the average person in North America, they're not seeing this prosperity at all.
No.
It's
very K right now.
Yes, exactly, very K. But what you do have in favor of stocks is they are a hedge over inflation. We have higher inflation, so in a really weird way, higher oil prices actually work for stocks, especially Canadian stocks. There is a correlation between higher oil prices and our stock market. It just kind of helps the.
But it's also balancing the trade-off with the higher gas prices.
Correct. Yeah. So, but for the individual, all they see is higher prices. They're not gaining versus the economy. They're kind of losing, but yet stocks continue to go up. I think what's happening, we had 35-year bull market in bonds, 82 to call it 2020. Mm-hmm. That is over. And I think bonds got massively over allocated to portfolios for what they are. They are a harbor of safety.
Yep.
And if you need that safety, you have it in your portfolio. If you don't need the safety, you don't have it. But we used to have these rules of take your age, and that's how much you should be in bonds. And that equation kind of worked for a while, but doesn't work anymore. So where is the bond investor going to go? Because this is the fifth year they're not making any money in bonds.
Now, they had started to inch up over the last little while, but it seems like they're flattening again.
Yeah, I mean, on a real basis, they might get their head slightly above water in terms of lifting over inflation, but not very much. You get a 1%, a 2% return in your bond portfolio. It's kind of peanuts, but And then you look over to the equity market and you go, oh, wow, like you can get 15% returns? Like, how about if you take 10%?
Even if there's a 10% pullback, you're still ahead of the game.
Right. So we believe that there's an asset mix going on away from bonds towards public equity specifically, because the privates, the private debt and or the private credit and private equity, they're kind of fraught in that bond market, and there's too many uncertainties. It's too murky of a world to understand what true value is. So the benefactor here is the equity market.
We're getting into a TINA. TINA's coming up more and more, isn't it?
Yeah, unfortunately. We like certain spots of the market. We continue to like it. We've been very consistent about that. We think industrials do very well in this environment. Anything cyclical, anything that has a high payback, what I mean, a high free cash flow to the current environment. So if you see a cycle and they get through their cycle in a year, wonderful. It's a great stock. If it's going to take 5 years for fruition to this product or service to really come to life, be cautious on it because you're waiting a long time. You don't know what the end of the rainbow looks like. Here and now, you can measure that really quickly. It's easy. Bring it in.
What about what would it take for you to look at bonds again?
Bonds are just a margin of safety. I minimize it for a lot of my client portfolios. I look at it and go, if you don't need it, don't be there. And it's just one thing that we do is long-term secular contrarians. So we look at what has been the secular trend and go, okay, there's a mean reversion here. It's going to play out for years. Bull market and bonds to 1982 to 35 years. We've never seen anything like that before. It's going to take years and years for this bond bear market to work itself out. So be on the other side of that.
All right. On that note, we'll take a break, but we'll be back with Patrick to see what is on the radar for him, including ATS. All right, time to see what's on the radar. We're back with Patrick Horan, principal at Agilith Capital, and ATS is showing up. What are you liking, or what are you looking at?
Yeah, this is a new position for us. Well, it's an old position and a new position. We had this for a while in the 2015 to about 2022 or 23, and it kind of got expensive for us, so we let it go, and we think it's come back. They help automate different industry groups, healthcare being their biggest. There's a reshoring of healthcare, medical devices, insulin pumps, that kind of thing. When we talk about bringing back manufacturing, we don't necessarily bring back manufacturing the old way. A lot of it is robots and automation now, and they help put that whole assembly line together. They help do the measurement, the testing, the company has a new CEO. He's just started. They just had a conference call. We like what they had to say. Focused on free cash flow. Focused on increasing that the amount of cash going through the system and coming out. It's going to free up some potential acquisitions. Their balance sheet is in order. They're trading at the cheaper end of their historical range. And if you look at their peer groups, they're about 50% undervalued. So we think the story has a lot to play out here. This was our first call with management. They just reported last week. The stock did sell off on it. We look at it and go, that's just a algorithm that kind of played out. But we think this is the exact environment. They have a nuclear side, they've got a consumer product side, and healthcare. And I think the one thing the market was disappointed by was the lack of growth in their backlog and their bookings. So you want to see that grow. But all of the other stuff, this new CEO is doing his job, and he'll get to that bookings. And I have no problem. I'm pretty sure they're going to have higher bookings in the future. This company's worth a lot more than what it is. So
where's the CEO coming from?
Oh, it's a good question. It's another it's kind of another diversified industry or diversified business, and he's got similar background in the M&A. The former CEO has left for a bigger position somewhere else. I can't even remember. Hilder was the former CEO, I really like what he had to say. Like he was kind of a no nonsense guy, squeezing everything out of the lemon, tightening the reins in terms of working capital. And that is right. Like that is what we look for in turnarounds. And this is a turnaround. This stock has really not performed for the market in like 4 years. So.
All right, let's get to the other one. TELUS.
TELUS, yeah. So you probably, once upon a time, like a year and a half ago, I was short all the telcos and on the idea that they're going to have to cut their dividends. That happened. We were made some money on it, and Bell cut their dividend, and we're still short Rogers because of their debt load. And we've been looking at TELUS as a potential change agent. It's going from kind of a negative story. Now, TELUS has not performed. It's actually been a dreadful stock to hold. It's 4 or 5 years now, and it just seems to go down every year.
Yeah.
There is new management, and it's the former CIBC CEO, Victor Dodich, who has done wonderful things at CIBC. Took CIBC from really what was a bank, a Canadian bank, smallest that was most likely to run into sharp objects, to actually a premium bank. With a premium multiple. That's the first time CIBC has actually broke out of that ranking. So they actually have a growth multiple in the banking sector. We think that that kind of magic will happen with TELUS under his leadership.
But even in telco, I mean, aren't they? Where do they go?
Where do they go? So they don't have to go very far. So they have like an 11% dividend.
Yeah.
We know that's going to get cut. Question is, how much does it get cut? And they've got so many different levers, so many different assets that's not being properly valued by the market right now. So they've got this healthcare side, they've got this farm agricultural side, they've got information technology side. They could sell that off and collapse their debt. And our best guess is that you might see a 30, maybe max 40% dividend cut. That gives you a 7% dividend. That's a champ. That's still a very undervalued dividend. And and then you slim down, like they've got the data center side. They got 3 data centers that they're working with the government of Canada on in BC. And you talk about a sweet spot. And the US is complaining about how these data centers are competing with the average person in terms of electricity prices. I mean, BC, 90% of their electricity is hydro, right?
Yeah.
So talk about a perfect spot to export this compute power all over the world and in Canada and have it our own. And TELUS is going to be in charge of that. So we that's part of the growth. And we also think that what we're seeing in wireless prices, we're hitting rock bottom now. We keep on bouncing down to the same levels, but we're not going down any further. So we think we've cycled through the worst part of the compete cycle in wireless margins. All right. So there's a really good story here going forward on TELUS.
Okay, we got to wrap it up on that note there. But still ahead, a new report warns of Canada's AI risks. We'll dive into that with our next guest, Curtis McCord, policy analyst at the Canadian Anti-Monopoly Project. And of course, our phone lines will open soon for our first call segment. Reach out at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Canada-U.S. Trade Minister Dominic LeBlanc is traveling to Washington today to meet with his American counterpart. It comes as Canada's official negotiations over its trade agreement with the U.S. have yet to begin. The Canada-U.S.-Mexico trade deal is subject to a mandatory review. U.S. Representative Jameson Greer suggests the Trump administration is unlikely to rubber stamp a renewal. Shares in Alphabet are down in pre-market trading. The parent company of Google plans to sell $80 billion in stock, including a $10 billion investment by Berkshire Hathaway. Alphabet says the capital will fund investment in AI. Alphabet stock has more than doubled in the past year as investors applaud its AI investments. Shares in Hewlett Packard soaring in the pre-market, up 25% right now after its forecast for annual sales topped estimates. HP citing growth in AI driven by demand for its servers and networking. The company is one of the largest makers of computing equipment, benefiting from the demand for hardware to train and use AI. And on that note, the federal government releasing a draft of its AI strategy, but a new report today is warning that Canada is at risk of dependency on other markets if it doesn't address key vulnerabilities in the AI economy. Joining us now is one of the authors of the report, Curtis McCord, policy analyst at the Canadian Anti-Monopoly Project. Curtis, thanks very much for joining us today.
Thanks for having me.
What's the biggest takeaway, biggest concern from your report?
The biggest concern from the report is that there's a high degree of concentration in the Canadian cloud sector right now, and that concentration is quite possibly going to extend into the kind of emerging AI sector if certain features of the market aren't corrected.
And how do we get around that? I mean, do we have enough room for enough companies to try and spread that out?
Well, the key will be making sure that the government strategy includes competition as a top priority. So in cloud computing, which is infrastructure for holding data and running services and stuff like that, one of the main obstacles to competition, besides the fact that there's just consolidation and economies of scale, is the fact that it's so expensive and cumbersome for businesses and buyers to switch between different providers, which lessens the kind of natural competitive forces of the market. AI is set to kind of extend and deepen those dependencies, meaning that businesses or other users won't be able to easily mix and match between different vendors, that they'll become beholden to dependent on specific vendors. And because there's not already a lot of vendors in the space, it's just going to accrue more revenue to those existing giants.
So what do you think the solution is? Do you like go to Samsung and Hynix, or who do you bring in? How? Because I don't see a tech or a chip industry, at least, to backfill that, that side. What are your thoughts on how to pivot here properly?
Yeah, our thoughts is that it doesn't necessarily, the focus doesn't need to be on who is brought in, but the conditions under which they can compete. So what we're advocating here is for an approach that the government should take with procurement, and hopefully some of these benefits extend to the private sector as well, that focuses on interoperability and portability and tries to make the kind of basic infrastructure and resources that computing provides to businesses a kind of commodity, something that's more fungible, that they can get from different providers, and to make sure that for different parts of their business operations, they can choose multiple vendors, that they have the power to move their operations and their workflows between vendors.
And should government be involved in the project itself, or should it just be about regulations from the government?
Well, I think the government is a major buyer of cloud services and is probably going to be a pretty big buyer for AI services as well. So I think the first step is actually building those technical requirements into their procurement contracts and saying that, well, if we're going to be buying these services, they need to work with technology we're already using. They need to work with the existing kind of state of the art in terms of industry standards and things that people already use. And over time, we're hoping that those kind of technologies become more interoperable across providers, that kind of interoperability is available for the private sector as well. Regulation, I think, does play a role, but not necessarily, we don't necessarily need to be minting standards from the top down.
And do you see the Canadian project of AI as kind of an area that is needed for our defense and our intelligence, our own intelligence and privacy from a sovereign standpoint?
I mean, that's a very complicated question, right? Because there's a lot of different kinds of AI. It's going to be applied into a lot of different fields, and the key is making sure that there's flexibility in our ability to choose the best tools from the best vendors, the best in-house, do the best in-house work we need to do, and apply that and find the most effective solutions across all manner of different files. The experts in each of those specific industries, in each of those specific sectors, will probably have better opinions on where it's going to be most valuable to them. But the key is keeping the options open and not becoming dependent on a small set of vendors.
Did your report do any work on the comparative advantages of a Canadian-based solution versus another solution? I mean, we have cheap electricity, we have green electricity, and I know Mark Carney has done a real push in getting the rest of the world to buy green, even when it's priced similar, because it is green. Is there any, have you thought about that as a contextual angle to your recommendations?
Yeah, I mean, there is definitely an angle there. I think in terms of making sure that infrastructure build-outs are done with kind of sustainable power sources, energy use, because as you note, like, some of these projects are extremely energy and water intensive, and they have big impacts on the community. And like right now, the market consolidation is such that the big kind of players are able to kind of almost steamroll with development and get huge installations installed that may or may not be necessary in Canada's case. And it's quite possible that Canadian companies or other interested companies could kind of innovate in that kind of from that kind of sustainability perspective and find more efficient and effective ways of kind of running these these operations.
And I mean, for now, 2/3 of cloud computing dominated by the big three, essentially, the big three: Google, Amazon, Microsoft. What do we do with that, and how do we get it to a point where we're not as reliant on them?
Well, I mean, as they're experiencing right now in Europe, where they've had the Eurostack initiative running for almost 2 years now, it's not really an easy question to answer. That dependency is at the infrastructure level, so it's very difficult to kind of move business operations, to move workflows and stuff like that. So the key is not necessarily to try and get a clean break right now, but to set the conditions where over time, moving between different providers, mix and matching different vendors and technologies is a lot more technically and organizationally feasible. Because right now, the costs of moving in terms of retraining, in terms of financial costs, paying the egress fees are prohibitively expensive. So that's kind of what we need to address. We need to create the conditions so that that government or other cloud buyers can kind of more easily choose between vendors. And then competition can kind of come in and enter the market. We can have different kinds of smaller, more boutique or specialized firms fit their technologies into a kind of portfolio of assets or a portfolio of operations for a company. And then we have competition based on quality of service, again, instead of just scale and lock-in.
All right, we have to wrap it up there, Curtis, but thank you very much for joining us.
Thank you. It's been a pleasure.
Curtis McCord, policy analyst at the Canadian Anti-Monopoly Project. Still ahead, today's market drivers with Bloomberg's Janine Panzer. And our phone lines are open. Patrick Warren is taking your questions on North American equities. Call us at 1-855-326-6266. Email first call at bellmedia.ca. Time to take a look at some of the early market movers, and for that, we're joined by Bloomberg's Janine Panzer. Janine, thanks as always for joining us. Let's get right to it. Victoria's Secret is soaring right now.
Yes, good morning. The shares are soaring pre-market. Last I checked is almost as 40%. This comes after the company reports earnings and it beats analyst estimates and also raising its full year outlook. Is embracing the era of the plan that the CEO does the new sexy. So let's look at the numbers. The luxury retailer raised the annual net sale guidance to as much as 7.1 billion and reported net sales of 1.5 billion for the quarter, exceeding analyst estimates. So an updated outlook suggests that the turnaround plan from the CEO of Super is building momentum as company focus on bras and the pink brand that's geared towards younger shoppers. So the company's recently changed the ticker to today to VSXY, part of its repositioning, Roger.
All right, so strong top and bottom lines. Marvell, surging right now, could be the next $1 trillion company, at least when a certain person says that. That matters, doesn't it?
It does matter, especially when it's the CEO of NVIDIA saying it. Jason Huang yesterday at an event, I think Computex, it's a trade show in Taiwan. He said it alongside Marvell's CEO that now that the useful AI has arrived, then it could help the company becomes a $1 trillion company, which is more than 5 times its current market cap. So NVIDIA, this has something to gain by saying so. The chip giant took a $2 billion stake in Marvell 3 months ago as part of its broader partnership. Marvell is among several semiconductor companies enjoying gains this week from the renewed euphoria around the AI boom.
All right. And Berkshire Hathaway liking what it's seeing in Alphabet?
Berkshire Hathaway this morning trading just about flat, but it makes a $10 billion investment in Alphabet. This is through private investment. It's split into 2 parts, Alphabet Class A and Class B shares, with Berkshire buying the stock at a discount of the market price. This investment, though, is part of Google parent's broader $80 billion capital raise to fund AI infrastructure. It's an era of raising a lot of money, as we see from different companies. But what's interesting here is that Berkshire is putting a sizable amount of its capital behind one of the biggest players in AI. But our in-house analysts don't see this as Berkshire suddenly becoming an aggressive tech investor. So Alphabet fits the type of company that Berkshire has long favored. These 3 things: dominant, highly profitable business, and with durable competitive advantages. Yeah.
All right, we'll wrap it up there, Janine, but thanks as always. Bloomberg's Janine Panzer. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a bullish call on CoreWeave. Let's take a look at some of the notable analyst calls and recommendations. BNP Paribas has initiated coverage on CoreWeave with an outperform and a price target of 192 US. The firm views the company as a premier purpose-built leader in the secularly growing AI cloud infrastructure market and is well positioned to benefit from substantial tailwinds. Jefferies has downgraded its rating on Hydro One from hold to underperform and slashed its price target to $48. The firm stating the stock became overpriced at 25 times earnings, pushing its dividend yield down to an uncompetitive 2.5%. Well, the federal government is expected to make its decision on a multi-billion-dollar submarine bid between South Korea and Germany by the end of this month. South Korea's Hanwha is now promising to use Canadian steel, but only if it's selected. CTV's senior correspondent Judy Trin reports.
A united front to announce a new partner in a plan to strengthen the auto sector.
How Canada's auto sector can pivot.
The diversification plan now includes using Ontario steel to manufacture Hanwha's Howitzer K9 and other vehicles in Canada. The South Korean defense company has thousands of orders from 6 NATO countries for these armored vehicles. Making them in Canada could be an important lifeline for the hard-hit industry.
The economic activity that comes from that deal for automotive is the equivalent of 1 new car plant here. And so what that means is probably 15,000 direct jobs.
The steel in the vehicles will come from Sault Ste. Marie's Algoma Steel, where about 1,000 people have been laid off.
We are the only steel producer in Canada that can make ballistic-grade steel for defense applications. It's a great opportunity to be part of a consortium.
But it's all contingent on Hanwha winning the massive bid to build Canada's fleet of 12 new diesel-electric submarines. Last month, the South Koreans sailed the KSS-3 to Victoria to show it off. The submarine, built by German competitor TKMS, is still under construction. But Germany is trying to make waves in other ways.
The program creates and sustains more than 650,000 jobs over the next years. The impact on the GDP will amount to 86 billion Canadian dollars.
As the economic promises increase, the government is hesitating but not ruling out splitting the procurement.
I don't know if you can categorize, Judy, the safe decision being splitting this down the middle. I think what we're looking at here is making sure that we have a fleet that is interoperable.
Both the South Koreans and the Germans are offering significant industrial benefits. The Prime Minister says he'll make his decision before the end of June, just before the July 1st deadline for reviewing the Canada-US-Mexico Free Trade Agreement. Judy Trin, CTV News, Ottawa.
And when we come back, Patrick Horan takes your questions on First Call. All right, time for First Call, first email, and that goes to Graham. Graham says, good morning. With the infrastructure boom coming with increased government spending on, I notice how you put that in parentheses, I think in quotation marks, spending on projects, do you have any picks on companies that may benefit, e.g. construction, design, project management, etc.?
Yeah, we continue to like Atkins Realis. They they have an engineering side, a project management side, and they have a nuclear side. And we like both businesses. The stock has not been a good performer this year. It's been pretty mediocre for the most part. And we think there's a lot of fears AI is going to come into the engineering space. But we see AI as an enabler to getting projects done in less time with, and I think we think it's going to be beneficial. The other one that we don't own that comes to mind is Aecon Group, and their stock has performed very, very well. If you recall, they're going to be sold to a Chinese company like 2.5 or 3 years ago, and that got blocked. They're the direct benefactors of these big projects.
I guess the big question is, are we going to see the big projects? And hence the quotation marks on
We think so. There's Aecon stock. We think so. We think there is no restraint among any government in the world right now in terms of their spending plans. They all see this as an emergency time to spend, to defend, to bring back, to shelter their sovereignty in some way, whether it's trade or whatever the excuse du jour is. They're going to spend over their budgets, and so this is a good area to be the benefactor of in terms of a supplier. So we do like the space.
Okay, let's get to this email from Al, and if you look at it, it looks like from AI, but from Al, is Micron a buy now?
Yeah, I wouldn't go near Micron. There's a circular reference that at some point, Google is raising money, and you got to ask yourself, they bought back their stock, when it was 50% of the valuations of where it is right now. Like they've been buying it back all the way through, and now they're raising money, and you're going, what? At my point, Micron sits at the top of the stack right now because memory is dear. I've been around the tech cycle for since the 90s, and memory chips are always the ones that get double, triple, quadruple ordered, and then the bottom falls out, and you go, what the hell happened to all the demand, right? What's going on? And so the circular reference is at some point, the hyperscalers are going to run out of money. They're using other people's money as guarantees. They're using Berkshire in this case. They're raising money from wherever they can. They're putting their own free cash flow that used to be magnificent into this. And there's massive margins because they're all trying to get through that small door at the same time. And they're just creating big margins for all the suppliers. And chips are the new oil for AI, right?
Yep.
That will run out. That will play its course. If you want to be part of the casino, speculate. It's probably going up still. But if I had a 1-year vision or a 2-year vision, I wouldn't be able to sleep at night owning that stock. So.
All right, let's sneak in one more email. We've got about 30 seconds. Mike would like to get your guest view on Finning.
Yeah, Finning's one that we own. We own from really the 2020 time, 2021. We quite like it here. So, copper and oil is really what they're exposed to. They sell CAT equipment in various geographies. And again, they will be a benefactor of infrastructure. But probably the more cyclical component is oil and copper, copper in South America, oil in Canada.
Got to wrap it up there.
Oil in Canada is an industrial now.
All right.
That's my point.
That's it for us on the street. Patrick, thanks as always for joining us. Patrick Horn, principal at Agilith Capital. And that is it for us. Lindsay's up next with the Open. Trading gets underway in 30 minutes from now. Have a great